Good morning, everyone. Good morning, everyone. It is Monday, January 13th, 2025. It is so good to see you all this beautiful Monday morning here in Austin, Texas. Lots to go over this Monday morning. We're going to go over the new listing to pending ratio, do a complete market overview. We're going to talk about the bond market, see what's going on with rates. So we're going to hit it hard. A lot to go over this morning. A lot going on this week. This is going to be a very important week for the bond market. A lot of data coming out this week that will influence the bond market in a very significant way. And really a lot going on within the overall market that we have to be very aware of. So let's go ahead and hit it hard. We are going to start by updating our amazing and tried and true and very reliable new listing to pending ratio. So that we can make the very best use of time, I went ahead and updated all of the previous weeks because I do want to spend a decent amount of time going over the market so that we understand exactly what's happening here in the first 13 days of January. I want to remind you all that this new listing to pending ratio simply takes everything that is new on the market. We add everything that is back on the market, and then we divide that by everything that is active under contract and pending. That's going to give us this ratio. When the ratio is at exactly 1, that's going to give us that perfect market equilibrium, meaning 1,000 homes came on the market, 1,000 homes were absorbed by the market through demand, and therefore inventory neither goes up nor it goes down. When that ratio goes over 1, that means that more properties were absorbed through demand that came on the market. When that ratio is under 1, that means that less properties were absorbed. So therefore, over time, inventory will increase because in relation to new listings and back on the market, demand is less, and that's going to show us on the ratio under 1. That's what this all means. Now, on the broader scale, when a ratio is at a 0.75, that will give us that neutral market, decent absorption, inventory increases very slightly over time, but that is considered a healthy ratio between a 0.75 and a 0.9 healthy ratio. When you start getting to the 0.9 to 1, that signifies a high demand market. That means buyers are out there, they're submitting offers in relation to what's coming on the market. A ratio over 1.25, that means that you have way more demand in relation to what's on the market. Once that ratio is under 0.6, that is a softer market. And when a ratio is 0.5 or below, that's a market that just hit a wall. That is a market that in relation to new listings coming on the market, that demand simply isn't there. And that means that inventory is about to explode because demand is half of what the new inventory is entering the market. Therefore, inventory really starts piling up. So that's what this all means. Let's go ahead and start updating this week. Not only do we track the new listing to pending ratio on a week over week basis, but we also track it on a monthly basis so we can get an overall picture of what's happening throughout the entire month. Number of new listings. Let's do a really quick recap for 2 weeks ago. 2 weeks ago, we had 629 new listings hit the market, a massive 372 price increases, most of those new construction. The number came out to about 96% of those new construction. 913 price drops. That gave us a percentage between the price drop and price increase of 71%. 177 back on the market, 28% back on the market, 302 active under contract. These numbers have all been updated, including the 286 pending. That's been updated, just updated that a few minutes ago. And that gave us a ratio of a 0.73. So slightly under that line that we draw of that 0.75 ratio that really does give us that balanced market, neutral market, neither too cold nor too hot, just a blah kind of market. And we can see right there that the average mortgage rate at 6.91, we use the Fannie Mae weekly rate update that comes out every Thursday at 10 a.m. for that rate. That does not signify the current rate on the market. We're going to go over that information here shortly. But that signifies the average rate for the entire country that is published every Thursday at 10 a.m. That is going to be a lagging rate, meaning it's a 2-week-old rate. It's published every Thursday at 10 a.m. for a survey that was done the week before. So not only do we use that number because it's a tried and true consistent number. We've been tracking it going all the way back to 1971. But we also have to keep in mind what the real rate is, and we are going to talk about that. The rate that we're using for this update, which covers the previous week from January 6th all the way through right now, January 13, is going to be 6.93. The real rate is going to be higher than that. At best, 7.375. Realistically, we are looking at a 7.5% rate environment, possibly even going higher. We're going to go over the bond market here shortly and discuss rates. Now, let's start updating this information. We're going to update the new listings from January 6th all the way through January 13th. Keep in mind that tomorrow morning, when you receive the update for this new listing to pending ratio, we will have the final numbers for new price increase, price drop, back on the market, and active under contract. Those numbers all lock at 11:59 p.m. tonight, and then we will continually update the pending numbers for the next few weeks. But most of the pending will be tomorrow morning. That's 80% of the pendings, and then they go up slightly over the next few weeks. Number of new listings, we are at 868 new listings so far, which means that we're going to end the day closer to that 950 new listing mark. Let's take a look at price increases right now. We are at 134 price increases, dramatically lower than the previous week at 372. Price decreases, we are at 979. That's going to shoot us back up to the 88% price increase versus price decrease. 88%. We just broke a 4-week trend. We are now seeing more price decreases. Back on the market, we should see 170 back on the market. That's 20%. That number is going down. That's going to be the lowest number going all the way back to November 2nd. Now let's take a look at active under contract, and you know the drill. After I give you the active under contract, which is at 337, not bad, 337, better than last week, way better than 2 weeks ago. So there's that 337. Now you get to guess the number of pendings over the past 7 days. Let's go ahead and get 5 guesses going on the number of pending transactions. Melanie Price is going to start us off at 179. Renee coming in at a bullish 237. Seth coming in at 198. We've got 3 down. We need 2 more guesses to go before I click on the number and release that. Charmine going over 200 at 203. Kevin Walker closing us off or closing us out or off, both. Either way, at 218. And let's take a look at this number. We are at, Melanie, you come in the closest because we are coming in at a 182. That's going to start us off at a 0.50. Little bit on the cooler side of things, which means that when this is all said and done, we are going to be under the previous week where we had a 0.73. 0.50, little bit on the softer side of things. And of course, we know why, because of rates. That's what's going on. And let us go ahead and update the monthly, and then I'm going to save this as a PDF, and we're going to review the PDF. On the monthly, so far, month to date, from the 1st all the way to the 13th, we are looking at 1,283 new listings. On price increase, we're looking at 427. Price decrease, we are at 1591. There's at 79%. January of last year, we were at 82%. So slightly under what we had Last year, there's that 79%. The reason we're at 79% is because of all the price increases that occurred 2 weeks ago from builders that came into 2025 a little bit more bullish than they should have because they did not anticipate such a large increase in interest rates. I do expect this percentage to go up in the next week to 2 weeks because we are starting to see way more price decreases because of interest rates. Back on the market, let's take a look at this number. We are at 271 back on the market. 21% active under contract so far month to date, 494, and pending we are at 311. So there's that 0.52 ratio so far for the month, you all. For the entire month, we're at a 0.52 ratio. And you can see how inventory will absolutely start to increase quite a bit. Listing agents, be very cautious as you are listing properties for sale because you're going to have way more competition going into February, March as this ratio gets stuck under that 0.6. What we say is that at a 0.7 ratio to 0.6, inventory grows up in a tangible way. When that ratio gets closer to that 0.5, it goes up in a substantial way. Inventory goes up substantially higher at that 0.5, 0.55 ratio. A ratio under 0.5, there's only one word to use, and that's just a absolute catastrophic, just about zero demand for real estate. So thankfully we are over that 0.49 ratio, but we're very, very close to that. So we know that inventory is going to go up. Renee said, yikes, that's a low ratio. However, anyone else seeing an increase in showing activity? It really depends on the property, Renee. Very much depends on the property. Some properties, no doubt about that. I just got a report from an agent saying we just had a killer open house, lots of activity, people wanting to submit offers, people interested. And then another property, different part of town, it's like, nothing. Not even a showing. Absolutely nothing. So we all know that real estate's going to be hyper local. Some area, and what I'm noticing, Renee, is that the 25th percentile continues to do very well. You start getting to that 50th percentile into the 75th percentile, that is the price point that's hitting a wall right now. So under 25th percentile, so you take the median sold price right now at $400,000, which is amazing. It's actually under $400,000 so far, the median sold price for the month of January, which is, I just didn't think that was going to happen. It's just amazing. We're going to go over all that information here shortly. So you take the 350 to 375, we see that price point moving quite well. And then you cross the over 50th percentile into the 60th, 70th percentile, we're noticing a pretty dramatic pullback. Does that make sense? But we are seeing activity pick up within certain price points. And I would say right now, what we're noticing is a certain segment of the buyer population is now concerned that rates are going to get up to 8%. And they're like, oh my gosh, I should have bought at 6.375. I missed out on that. Oh, I should have bought at 6.75. I should have bought at 7. I should have bought at 7.25 or 7 1/8. Now I'm at 7.5. Let's just go ahead and lock this in before it gets to 8. So we are seeing movement in the market because of the fear that rates are going to get into the 8. Does that make sense? That is happening right now. And there's a lot of chatter going around that this year is going to be a brutal year for the bond market. We have $9 trillion worth of national debt that has to be monetized at that 10%, at that 10-year maturity. And we know that that correlates very well with mortgage-backed securities. That is why the price of the 10-year treasury is going down. the price of mortgage-backed securities going down. As the price goes down, the yield will go up. And that is what we're noticing. On top of that, we have a very strong job market. And we have, I would say, a lot of different aspects of the economy are actually strong in that. I mean, the job numbers were absolutely amazing. I mean, they were just about double what the forecast was. So you've got a little bit increase in inflation. You've got inflationary pressure with a strong job report, strong job market, with a lot of debt that has to be monetized. It's the perfect storm for a high yield environment. It's the perfect storm for a high yield environment. That's what's going on. Was there sector info regarding jobs? Yeah, absolutely. So if you go to the job numbers, it breaks down each and every sector. Of course, government added 33,000 jobs, I believe. We did have a pullback within manufacturing. That actually went negative. Service sector and healthcare continues to trend on the positive side of things. I put healthcare along with government jobs. Healthcare jobs are government jobs. If it weren't for the government, we wouldn't have a healthcare system. So that it is what it is. Do you think the job numbers are real, or are they going to correct them soon? Well, they've already corrected it for the previous. They continue to correct. We did see an 880,000 job correction. We saw another 660,000 job correction. But the market moves based on the headline, not as much based on the correction, right? So we know that if the job numbers come out positive and that's the headline, the market is going to just react and act based on that headline. We know that that's going to happen. The JOLT job opening labor turnover report number also came in hotter than expected. And all those things are going to affect the market. No doubt about that. Let's take a look at closed. We are at 760, you all. Oh, 760. This is for the 6-county area. This is for a population of 2.2 million people. So we've got, for the first 13 days of the month, 2.2 million people live in the 6-county area, and we've had so far 760 closed properties. Wow. Now, I do expect this number to go up quite a bit because we had 2,670 properties go under contract last month. That was less than December of 2023. So we noticed that the market started slowing down right there, December 2024, because November 2024, year over year, we exceeded November of 2023. Now, if we've got a 20% back on the market, that means that we're going to shave off roughly 520 or so of these properties. That's going to put us closer to the 2,000. We're at 760. That's going to be a lagging indicator. So how many closings can we expect January? Yeah, I would say we're going to get very close to January of 2024, where we had 1,939. I'd say we're going to get very close to that. I don't think we're going to go past 2,000 closings so far this month. We are starting off the month a little bit on the slow side of things, but that is normal because of where the first of the month ended up this year. It just ended up right in the middle of the week. That basically did away with the entire first week of the month, and we're playing catch up with closings. Let's take a look at withdrawn. How many withdrawn so far? We're at 243. That's a high number, 243. A very high number on withdrawn, being only the 13th in the month. And let's take a look at how many expired. We're at, 214 expired already. 214 expired. Let me go ahead and just move this out of the way so that I can save all of this as a PDF and we can review the entire package in all of these numbers. In the meantime, what I want to do is I want to take a look at the new listing to pending ratio for lease. I went ahead and updated this information earlier today, and take a look at where we are on the new listing to pending ratio for lease. Just let that sink in a little bit while I save this as a PDF. We are at a 0.58 ratio, you all, for the new listing to pending ratio on lease. That is just amazing. We are not noticing a huge demand on lease in relation to properties that are coming on the market. That just amazing what's going on the leasing side of things. Inventory on the leasing side is going up quite a bit. Let's take a look at some graphs right here. And what we're going to do is we're going to focus on this one. You can see that new listing to pending ratio at a 0.50, because we're right at 0.50, just plummets down. And this is the new listing to pending ratio compared to rates. When the red line goes down, that means that rates are going up. When the red line goes up, that means that rates are going down. And you can see that when rates, let me go ahead and just start drawing. When rates go down, activity goes up. When rates go up, activity goes down. It's amazing how related they are to each other. It's all about PITI. It's all about what people can afford. We can see that the ratio so far this month is at a 0.52. How does this compare? One of the metrics that I really like to look at is the difference between new and pending. And we are at 749. And we can see that when we take everything new on the market minus everything that's already gone under contract, we are now at the highest number going all the way back to 2011. So when you compare January 2024, 2023, we are way higher, 749. That is a substantial increase compared to January of last year. That's where we take everything new on the market, we subtract everything that's pending, and that's where we're going to get the difference. So really amazing. And we can see, look how we compare 2024 compared to 2025. Last year, 416. So far, 749. And we can see this right here. That's going to be the difference going all the way back to the year 2000. And let me draw a straight line. And let me see if I can lock this line. We are now at the highest going all the way back, there you go, to 2011. These dots signify the month of January. So you can see every single January difference between new and pending, currently at 749. We are at the highest going all the way back to 2011, and significantly higher than last year. Here's the new listing to pending ratio. We can see that last January of last year, we were at a 0.89 ratio for the entire month. And so far, we are starting the month at a 0.52 ratio. And there you go. You can see that 0.52 ratio is going to be the lowest ratio going all the way back to 2004. This is going to go up between now and the end of the month, but we are 13 days into the month. So the question is, where is this going to land? Where is this going to end up based on rates? If we do not see an improvement on rates here very soon, I'd say we're going to get very close to that 2011. It's going to settle somewhere around the 0.6 to 0.65 ratio. And that's going to put us in that somewhat dangerous category of a substantial increase in inventory. That's going to put pressure on pricing. So listing agents, be very cautious, be very careful. You've got to look at the competitive landscape where you are listing your properties. On the buying side of it, buyer's agents, we're all listing agents and buyer's agents. On the buying side, keep in mind, real estate is hyper-local. there will always be recession-proof neighborhoods, neighborhoods where you're going to see high demand, low inventory. And then you're going to have areas where your buyer's going to have all the leverage in the world. We are seeing properties go under contract. Y'all are doing an amazing job, but we're seeing properties going under contract at 85 to 90 cents to the dollar on properties that are priced correctly. They're priced right. When you look at the competitive or comparative market analysis, meaning what happened 3 months ago, it's priced right. It's going to appraise. But because of the competitive landscape where that property is located, that buyer has a lot of leverage, and the seller knows that. We reviewed the property during our Friday meeting where the seller bought the property May of 2022 for $1.35 million, and it's on the market right now for $850. I mean, just let that sink in. The seller bought the property May of 2022 for $1.35 million. It was listed for $1.25 million. They paid $1.35 million, and now it's on the market for $850,000. That seller will probably sell the property for $775,000, maybe even $750,000. So that's almost a 50% drop. I mean, it's just absolutely amazing. And in that specific area, buyers have a ton of leverage. Let's take a look at active listings for the entire month. So right now, we already have, we have to go all the way back to 2010 to get a higher number of active listings for the 6-county area. 2011 to be exact. We're only 2 listings away for 2011, which means we're going to completely blow 2011. When it's all said and done for the month of January, I expect us to end right around here. So we're going to get very close to 2008, 2009 on the number of active listings. Let's keep on going. Take a look at a few more things. You know, a lot of it we do cumulative readings. So we're let's take a look at active minus pending. This is a really good one. Active minus pending. And we can see that we have officially hit a 20-year high on the active minus pending for the month of January. So we're currently at a 20-year high for that specific number. We're going to keep on tracking this to see what's going to happen. I do expect this one just to go down a little bit as we get more pending properties between now and the end of the month, but it's still going to be elevated levels for I'd say even the entire year. It's going to be pretty elevated. So there's all the information, you all. We're going to keep on tracking this, of course, on a daily basis. You can always go back to teamprice.com. Tomorrow morning, you're going to get the latest and greatest. You can just scroll down under Insight and Statistics. You can go to New Listing to Pending Ratio. Tomorrow morning, this is going to be updated with all of the weekly fields that lock in. Let me go ahead and just close this and let us start talking about inventory and number of active listings. As of this morning, we are at 11,165 active listings currently in the market. That's going to be a gain of 95 from Friday, a 192 gain from a week ago. We are down 1,205 month over month. Year over year, we're up 12%. We have 12% more active listings today than we had exactly a year ago. We're currently at 3,308 pending listings. So we are officially trailing 2024 on the number of pending listings by 3.5%. That's going to put the activity index under 23%. We are now back to December 2nd territory at 22.9. And months of inventory is now trailing up. We are at 3.91. Here's another number that is increasing. We spoke about short sales, 36. That's now going to be a little bit of a record high number in recent history. 36 short sales currently on the market. And when I add all of the special listing condition, we are now over 4%. And that is a number that we have not seen in a very long time. When I say long time, I'm talking about a decade. Activity index for resale at 19.52%. Activity index for new construction at 28.7%. That is now under 30%. And you can see that active listings were up 12% compared to exactly the same day last year. Last year, we were at 9,970 active listings. We're at 11,165 right now. Pending listings, you can see that we are trailing 2024. We have less pending listings this year compared to last year by just a few. Last year, we had 3,428. This year, we have 3,308. So we've got 120 less pending listings today compared to last year. And therefore, what's going to happen with the activity index? The activity index is going to go down. Last year, the activity index was like a rocket ship going all the way from, let's say, second week of January all the way to the third week of February. Activity index just went up. Unfortunately, right now, we're noticing the activity index actually going down instead of going up. Only one reason. Everything is what, y'all? It's rates, right? That's all that matters. Rates, rates, rates. People shop monthly payment. That's all that matters. Rates, rates. It's what matters. Months of inventory, we are up 11.6% compared to last year. We can see that the last year inventory started going down all the way to the second week of March or second week of February. Or I'd say, well, this goes down all the way to the first week of February. And then it started going up. This time around, it's already starting to go up. Let's look at a few more things. Out of all the active listings on the market, 11,165, exactly 50% of those have had a price drop. Let me show you now the market cycle report. And then I'm going to show you, you know what? Let me go to residential inventory first. 8.7% year-over-year increase on inventory when you look at the entire MLS. 8.3% decrease on the number of pending properties year-over-year. So you've got an 8.7% increase in inventory across the entire MLS, an 8.3% decrease in pending activity. We can see that inventory is trending upwards, and you can see that it's heading in that direction. And you can see that pending, it's at best flat, but this year down a little bit, down 8.3%. That's how much rates are having an impact in the entire market. And you can see that the activity index for the entire MLS is trending a little bit on the downside of things. We were at 23.3 2 years ago for the month of January, 27 or 27.3, and then 27, and now at a 23.8. And that's going to be the lowest activity index in January for the month of January, going all the way back to 2015. Because if the number of active listings go up and the number of pendings go down, the activity index, which is going to be pending divided by active plus pending, that's going to go down. And that's a leading market indicator. And we know that if the activity index goes down, months of inventory, which is a lagging indicator, is going to go up. So we can see right here that we've got more actives, we've got less pendings. So when you've got a higher supply of homes with a decreased demand, what happens with pricing? What happens with price when you've got more inventory with a softening demand? That's the quiz for the day. Prices go down. So let us see what's going on with our market cycle report. Here's a number that I did not think I was going to see. Now, we are 13 days into January, so this number will change, and I am hoping that this number goes up. Statistically, more expensive homes sell in the first 15 days of the month as opposed to the latter 15 days of the month. That is a very common pattern that we see. But so far this month, the median sold price for our 6-county area is under $400,000. It's $399,999. And when my spreadsheet spit out this number, I went back to the MLS and I triple checked it because I couldn't believe it. So we are down so far. This number will change. We could be, this time next week, we could be looking at 425. Heck, we could be looking at 450. Maybe there's just a lot of more expensive homes that are under contract right now that are about to close, but it was delayed because of New Year's, because of a bunch of stuff going on, and they're all closing today. That could very well happen. But so far, we're down 10.9% month over month. We're down 6.6% year over year. On the average side of things, we're down 9.7% month over month. We're down 3.4% year over year. That is amazing. That is absolutely amazing. Now you can see just how predictable this line is. That's going to be the average sold price, which is currently at $519,636. And we've got January, 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 January. So on the average sold price, we are officially down 23.8%. Let's take a look at the median sold price. And look how predictable this line is. Isn't that amazing? You have your peak of the market, and then you have your bottom of the market. Right? So what's going to be the peak of the market? Peak of the market is going to be your May timeframe. Bottom of the market is going to be your November, December, January-ish timeframe. Peak of the market is going to be your May, June timeframe. So we do expect a line to go up as we go into the peak of the market. But when you look at year over year, and you look at every January, you can just draw a straight line. You can just draw a straight line. And we can see that year over year, we're down 6.6% from 4.8%, from 6.5%. So from the peak of the market to right now, we are witnessing 27.27% drop. A 27.27% drop. Here's the 4-year comparison. Blue line, 2022. Orange line, 2023. Gray line, 2024. Yellow dot, 2025. At exactly really $400,000. Just amazing. When you compare the median sold price to 2 years ago, we're down 11.1%. When you compare the median sold price versus 3 years ago, for the month of January, we are down 16.84%. And look at this drop. That's just for the month of January right there. Just amazing. Incredible. Now, if today is the bottom of the market at $400,000 and we use the 25-year compound appreciation for the entire Austin market at 4.487%, we can expect a return to peak May of 2032. That's 61 months from now. That's how long it would take for us to return to $550,000 if we simply use the 25-year compound appreciation. Now, you ready for a new chart? Are you ready for a new chart? I'll be 125. I don't know who admin is, but we welcome you here, admin. I'm supposed to be admin, so I have no idea who admin is. but we welcome your presence in our midst, Admit. Thank you for joining us. I've got a new chart. Y'all ready for the new chart? Oh, that's Jim. Welcome, Jim. Welcome. All right. Here's a new chart. I oftentimes get asked the question, well, how in the world does this compare to 2007? And we did not have a bubble in 2007. We went up by 5%, down by 2.5%. That was no bubble. We just completely, we had short sales, we had foreclosures, but we didn't have a bubble. But what we do is this. This is what I've done. I used the starting point of the 2007 real estate recession, which was December of 2007. That was the peak of the market. And then I used the starting point for this peak of the market, which was May of 2022. And then we forward 32 months into a market comparison. So 32 months into this market, we're down 27.27%. And 32 months into the last market, we were up 2.69%. Interesting, right? So that right there answers well, how does this compare with 2007? Well, I mean, there's just no comparison. There's just absolutely no comparison. Just really amazing. Just absolutely amazing what's happening. Let's take a look at a few more things. We're going to look at the sold to list price ratio because there are a few data points here that we also can glean on and understand and position our listings in a way that the goal is to sell listings. The goal is to service our buyers. We now have 8.7% of properties sold over list price. 8.7%. This number all the way down here, 8.7%. Where do you think that falls in the context of history going all the way back to January of 2000? Where do you think that falls? Kind of down the middle, on the lower side, a percentage of properties that sold over list price. Where do you think that falls? Okay, Seth saying low. Okay, 1999, so even prior to 2000. Let's take a look at it. Here's the 8.7%, and here's the minimum 8.7%. So we now have, so far, for the month of January, the lowest percentage of properties that have sold over list price. The lowest percentage. We had 9% December of 2023. And let me make my little boxes stick. 8.7 right now. We had 9% December of 2023. And then prior to that, we had 9.6% October of 2011. Now, we did have 9.4% January of 2024. That is in between. But we're at 8.7% right now. Pretty amazing, isn't it? And we can see right there that that number has been going down. And then we just now surpassed the bottom, which was October 2011. Melanie is saying, I wonder how much of that will correct by the end of the month. Melanie, it's one would hope, right? I mean, these numbers are so startling that one would hope that it is an anomaly based on how the month started, with New Year's being in the middle of the week, and maybe we've got a bunch of closings that haven't happened. That is where we can't just look at one data point. We have to look at the entire picture. And I'm having a very, very hard time finding any data point that is pointing in the other direction other than a very, very slow January and a very slow start of the year. Activity index, new listing to pending ratio, activity index on new construction, even though they're offering amazing rates and they're offering incredible incentives for buyers, not a single one of those is influencing any leading indicator. All the leading indicators are just kind of hitting a wall. And that's because rates have just gone up by so much, so fast. That right there is the biggest challenge that we are seeing. Now, the good news is that I just got Robert's rate sheet, and here's a number that I actually was really not expecting on his rate sheet, because Robert is coming in at 7.125. So I'm really excited about that. 7.125. I thought it was going to be closer to the 7.375. So that's really good news. I'm excited about that. It's going to be interesting to see how it plays out for the entire rest of the week, but that is a good thing. Violet said, do you think that all those withdrawn properties, which were expected to come back this selling season, think that's going to happen? 25% of those will absolutely happen, Violet, within the first 3 months of the year. So we are tracking year over year just about the same on the number of new listings coming on the market. Pendings are down year over year, so that is causing inventory to increase compared to last year. But when you look at the number of new listings entering the market, on Friday, we were up 12%. When I pull the data today, we're pretty much right in line. And we did have a pretty dramatic increase in new listings last year that was way higher than 2023. So right in line with last year does put us in close to record territory. And we are seeing properties that were withdrawn last year coming back into the market with very aggressive pricing. We are absolutely noticing that. We're also noticing a pretty substantial increase in lease inventory. Let me go over lease inventory, and then I'm going to go over affordability. Lease inventory, number of active lease listings is up 14.14%. So we are now in clear record territory on the number of active lease listings that are currently in the market. And we know that some of these are properties that did not sell last year. Everyone is super hopeful that the next year or so the market's going to rebound. So it's like, let's go ahead and lease our property, get a tenant in there for a year, and then we will reevaluate next year. We've noticed right now sellers doing that 3 years in a row. And we're now at 5,797 active lease listings on the market, which is just absolutely amazing to see this number. Now, City of Austin, same thing, record high territory, City of Austin. So what's happening with months of inventory? At 2.37. Still on the low side of things, but we see that rocket ship on months of inventory, both on the MLS and also in the City of Austin, both of those reaching 10-year highs. Now, with prices going down, I published a really amazing, exciting article that is actually gaining quite a bit of traction on the web. And that right there, let me see. Okay, let's just do a little bit of a refresh right here. Okay, good stuff. There's that refresh that I wanted. Getting a little bit of traction right there, which is exciting. But this right here is an article called Austin Housing Affordability 2025, Price to Income Ratio Returns to Normal. And this is really amazing. I did not think that we were going to have this happen so quickly. When you look at the median sold price to income ratio, you're going to be able to find this under the affordability section of Insight and Statistics. And we simply take the median household income and we take the median sold price and we just divide it. So we just create the ratio. The average ratio going all the way back 25 years is 3.73. The pre-pandemic ratio before prices just went up like crazy was 3.98. And I am happy to inform you that the ratio right now is under the pre-pandemic ratio. It is now at 3.77, and it is right there at the 25-year average, which is really amazing. And the mean is very close to the average. So properties are now the most affordable going all the way back to pre-pandemic, going all the way back to January of 2020. Here's January 2025. And when you look at the median sold price to income ratio, goes back to what I've been saying. I am a mean regression theory, is that over time, things regress to the mean. And I remember back in 2022-23 where I said, this line will go back down. And indeed it has. But here's a line that is not going down as fast. And that is the percentage of the income going towards the PITI, principal and interest, tax, and insurance. Right now, that percentage is at 34.92%. We got all the way up to 47.19% at the peak of the market, May 2022. But this has to go down to the 30%. It must go down to the 30%. It will go down to the 30%. It's just going to take maybe another year or so. Now, only three factors influence this line going down, whereas two factors influence this line going down. This line, the median sold price to income ratio, is only influenced by two factors. Number one, household income. If household income goes up, the line goes down. If prices go down, the line goes down. This line, on the other hand, is influenced by three variables. Number one, income. If you make more money, you can afford more. Number two, pricing. If pricing goes down, the percentage is going to go down. Third and final is going to be rate. So here you've got a situation where prices are down 27%. Therefore, the median, the household income in relation to the price, that's plummeted because prices have plummeted 27.27%. But the percentage of your income going towards the PITI has not fallen anywhere close to the same degree because rates are at 7%, 7 1/8, 7 1/4, possibly 7 1/2. Everyone's concerned it's going to go up to 8. So that's why we can expect additional pressure on pricing unless we have a pullback on rates, which I don't necessarily see that happening. I don't see that happening. Now, Violet, you do bring up a good point, which is this number, of course, because it is PITI, it's also influenced by an increase in insurance rates. We have updated the insurance rate calculation. We used to use 0.55. We now use 0.68, and we're going to keep it at 0.68 for the foreseeable future. But here's what I do. When I update the insurance percentage, which means as a percent of the asset value, which would be the median sold price, how much of it is insurance, I use 0.68. I actually go all the way back to like January of 2000, and I just make everything 0.68. I don't say, okay, from this time to this time, it was 0.5. From this time to this time, it was 0.6. From this time. So it's an easier way to calculate apples to apples as opposed to doing something different. So you get a really good comparison based on the insurance rate. But you're absolutely right. Insurance gone up. Taxes, of course, are awful. But this is a situation where the factors that influence rate and the factors that influence the bond market, which right now, almost at 4.8 yield. There are a few factors that are happening right now that are contributing to such a high yield environment. Number one, a decent job market, a very decent job market, good job reports. I mean, amazing job reports. So a healthy economy. You've got a lot of deposits right now with banks. You've got good job numbers. That, of course, is influencing this. That's number one. Number two, is some inflationary pressures that are not going away. We have not reached that 2% target that the Fed has for inflation. We're not even close to that 2%. We're not at 9 and 10, but we're not at 2. And it's really hard to get that inflation from 3 to 2, from 2.5 to 2. Very, very hard. And we're not getting that 2% target. And some of the leading inflation indicators are not that great. We've got a few numbers are a little bit hotter than they were expecting. That's number 2. Number 3 is we've got $9 trillion worth of debt that has to be monetized over the next 12 months. And primarily that's going to be within the 10-year treasury. So we spoke about that earlier. So all of those combined, you've got less likelihood that the Fed is going to keep on cutting rates. You've got more inventory of 10-year treasuries hitting the market. Therefore, you've got less demand for a higher degree of inventory, puts pressure on pricing. Pricing goes down, yield goes up. That is why I don't expect us to see like a huge drop in rates here in the foreseeable future. There's nothing that indicates that we're going to see that. So let's take a look at the economic calendar for this entire week and see what's going to happen. Okay, so we've got inflation expectation. This is for the entire week, by the way. So that came in at 3%, same as the previous. There's that 3-month bond auction that came in. Let me make this a little bit bigger for you all and a little bit smaller. That's good enough. We've got a little bit higher 3-month, a little bit higher 6-month. You've got a lot of commodity data coming out here today. Tomorrow, huge day. Huge day tomorrow. Tomorrow is all about inflation, PPI, Producer Price Index. And then you've got Wednesday where you've got CPI, Consumer Price Index. So you've got small business optimism. That's going to be big. You've got PPI, the input side of inflation, the producer side of inflation. That's going to come out tomorrow at 0730 hours. You've got Investor Business Daily, Economic Optimism. That's at 9:05. Huge day tomorrow for the bond market. If these PPI figures come in hotter than expected, forget about it. Expect yields to go up. Expect mortgage rates to go up. We've got economic optimism. If that comes in way hotter than expected, it could have a negative influence within yields. And then Wednesday is a huge day. That's when the true inflation numbers come out, CPI, Consumer Price Index. That is going to come out on Wednesday. And then on Thursday, we've got more inflation data. We've got export pricing, import pricing. We've got retail sales. We've got the National Association of Home Builder Housing Market Index. When that is released at 9 a.m., we're going to be able to update the new construction home buyer traffic walkthrough. That resource is in Insight and Statistics inside the Mortgage Bankers Association Index, which that one is going to be released also on Wednesday morning. Wednesday morning, the MBA mortgage application is released. And then going into Wednesday, we've got, let's take a look at it here. Thursday, we've got the Housing Market Index. And then we've got Friday. Friday is all about building permits, housing starts. We've got a lot of industrial manufacturing data coming out on Friday. So this is a huge week for the bond market, a very, very important week for the bond market. It could go either way. We could have data that supports a pretty substantial correction within the bond market, and all of a sudden we are high-fiving each other. We are rejoicing. We're talking about 6.875 rates. That's going to drive demand up. Or we could very well have a repeat of this where all of a sudden we are into possibly 4.95% territory. And if I go back 1 year, we are already, I have to go back 5 years. We are right now back to 2023 territory. That's where we are. We've already surpassed 2024. We've got higher yields than we had back in 2024. We're back to 2023, October, November timeframe, 2023. And we all know what happened with rates when we were back in 2023. Let me go ahead and open this up for you. Here you have it. Back in 2023, October, we got up to 7.62%, which meant we were close to 8%. I remember seeing pre-qual letters at 8 1/8, 8.125, some of them even at 8 1/4. And we all know what happened that last quarter of 2023. It's just a matter of people can't afford to buy when rates are this high. As a matter of fact, let me show you this bad boy. And this is also in affordability, because what you can see is that, look at the difference. This is amazing. Income required to purchase the median property. At 6.5%, your income required to purchase the median property, and this is purchasing the median property if you want 28% of your income going towards the PITI. At 6.5%, it's $128,000. At 8%, it's $142,000. That eliminates 15-20% of your buyer pool. 15 to 20% of your buyer pool is absolutely gone. Absolutely gone. This is all using 20% down. This is all using 2.25% tax rate. This is all using 0.68% insurance, right? We just kind of have to compare apples to apples, right? This is, I'm not going to use PMI, MIP. So this is like everything. Anytime that I use these comparisons, it's always going to be 20% down, so that I don't have to deal with PMI. And the reason why I cannot deal with PMI, MIP is because of this, is because your monthly premium on PMI varies dramatically. Your PMI monthly premium can range anywhere from 0.17 to 1.86. Right? So it's impossible. It's impossible to like create like a matrix and a grid that would capture all of this. It's absolutely impossible. So anytime I use PITI, it's always going to be 20% down, always going to be 0.68 insurance, always going to be 2.25% tax rate. It's just an apples to apples comparison. So that's what. And that's where on the insurance side of things, yeah, when I got into the business many eons ago, we used to use 0.25. 0.25 was the percentage insurance that we used to use. Right now, we're at a 0.68. And I'm in constant communication with insurance providers asking them, hey, when do I increase this to 1%? When do I increase it to 1.25? So you're absolutely right, James. Travis, home insurance is up 100% over 24 months. So that's why we keep on increasing this number, just to account for this insurance inflation. Violet said $400,000 median at conventional buyer. We'll need $100,000 down for closing. How many people will be able to afford that? You know, and that's why we also have this. So if you keep on going in this affordability, we do compare different types. So right here, we compare 20% down, no PMI, 15% down with a PMI of 0.23, 10% down, PMI of 0.46, 5% down, PMI of 0.59, and then FHA 3.5% down with an MIP, which is a 0.55. And that's going to give you that PITI with all of the different loan products. But you're absolutely right, Violet, is that when rates go up from a 6.25 up to an 8%, 25% of the buyer pool evaporates. They no longer can afford that. It's just an impossibility for them to afford that. Your income would have to increase substantially for someone to afford that. So that's going to be this column right here. This column inverses the equation, and it says, hey, if I want my PITI to be $3,000 a month. Of course, with 20% down, we're simply using this as a comparison tool and as an education tool. Each buyer's different. Each buyer can afford something different, but this is simply an education and comparison tool. At a 6.5% rate, you can afford a $400,000 property. At 8%, you can afford a $360,000 property. So you have a situation where $40,000 worth of buying power is eliminated because of a rate increase. Now imagine this, at 3%, you can afford a $516,000 property. So you just witnessed a 30% erosion in buying power simply because rates have indeed gone up by this much. And hopefully I will not have to add another line to this resource going from 8% to 9%. I don't want to do that. I want to keep it at 8%. But that goes to show just how much rates influence a buyer's ability to purchase real estate. And of course, you can find all of this information right there in the affordability section of the website. You can go to affordability and you've got all of this amazing information. It is 11:06, you all. I want to honor your time, but I do want to open up any questions, comments, concerns, criticisms, complaints. Any questions, comments, concerns, criticisms, or complaints?
I have a question.
Yes, Violet left. Go for it.
Now, what's your prediction for the 2025 selling season, or expectation, not prediction?
I went from being cautiously optimistic. That's how I finished last year, especially with the data coming out November and December, with demand up, prices up. I am now entering 2025 with a substantially higher degree of caution, and this is for the market, and with less optimism when it comes to pricing and when it comes to the demand side of the equation, especially with the dramatic increase in rates. So we are seeing a year over year, of course, drop in pendings, increase in new listings. We're noticing a pretty substantial increase in inventory, and that will cause sellers to adjust their price. So we are going to notice more pressure on pricing. For buyers, that's going to give them more opportunities. So now for team price, I'm still very optimistic when it comes to team price. I feel like I feel like you all are positioned in a very, very good way, an excellent way. But as far as the overall market is concerned, I will not be surprised if this didn't look a little bit closer to 2023. And that's certainly not something that I was personally hoping for. Does that make sense? Yeah, way more cautious. I'm way more cautious going in. But once again, we are only 2 weeks into January. But oftentimes 2 weeks into January gives us, and I told you all, hey, by the third week of January, we're going to have enough data to see at least how the first quarter is going to position itself. And so far, with a new listing to pending ratio, with the activity index, with rates, with pricing, with all the leading indicators now affecting the lagging indicators, it's like, oh, goodness. Now, what are some of the variables that will dramatically alter the landscape of real estate? Like dramatically. Well, of course, it would be a lowering of rates. That would have a dramatic impact in demand for real estate. It's all about rates. Lower inflation numbers, prices actually going down. All of those would have positive effects in real estate, but too early to tell whether or not that's going to happen. If things stay closer to that 7.5%, 8%, it's going to take the buyers a good quarter and a half. So we're looking at 90 to 120 days to adjust to that new reality. But even if the buyers adjust to that reality, it's about affordability. Like your point of like, man, how many buyers can afford 20% down? at 7.5. It eliminates a huge buyer pool. So now the price of that property has to go down. It must go down by another 10 to 15% in order for that 7.5% buyer to afford that property. The price has to go down. And that's the pressure that we're seeing right now in the first 13 days of the month, is sellers adjusting to that pressure. When you look at the absorption resource that we have, absorption rates and market demand, let me make this a little bit bigger for you. You can see this. What are the highest absorption rates? Well, so we used to be on the dark green, which is high demand at the $300,000 to $400,000 price point. We were noticing high demand. We're not seeing that anymore. We're now seeing the light green, which is strong demand. But look what we're noticing now. We're noticing more zip codes where? On the moderate demand. So we are noticing these numbers shifting in this direction. We're noticing more and more zip codes and more price points falling within the moderate demand as opposed to the strong demand. And of course, we are starting to pick up the red. And the red is what? The red is going to be the low demand. That's what's happening. More and more price points, more and more zip codes and price points are following within both the red and the yellow/orange. So that's what's going on. So there you have it, you all. Very good question. Does that address your question, Violet?
Yep. Thanks.
Absolutely. Good stuff. Good stuff. Well, any other questions, you all? Yes, go for it.
I think you missed my comment, but
Oh, which
on
one?
the MLS, when you open it up and it's talking about AI generated listing input or something like that. And I was curious if you had already heard about that or if you're finding out with us.
Yeah, I mean, well, I only hear stuff when y'all hear stuff. So there's no such thing as like a broker secret email that goes out. You know, we're
No.
kind of treated exactly the same. So
Well, I don't know. You have inside intel sometimes.
Oh man, I try to stay as far away from those fools as possible. I'll say that much. Well, I read this, Get Ready, Supercharged. So I read that and I was like, okay, whatever, right? You know, AI powered listing entry management system. No idea. I haven't seen it. I have absolutely no idea. So I'm excited to see it personally. I mean, robust CMA, well, anything is better than what they currently have. So that's a win. You've got agent branded client collab center, one home. Well, if that means better communication with the client, I think that's fantastic. I mean, anything that makes the listing entry and management better than the way it is, it's a win. Anything that makes it better, it's a win. So first thing that I thought when I saw this was, well, that's pretty cool. I mean, it can't be horrible. It can't be bad. I thought that was really neat. I didn't see any videos on it or anything like that. I don't even know that they have any kind of videos. Right, just stupid stuff, you know. It's like, at least give us like AI image search and listing match score. Well, I have no idea what that means.
I think what concerns me is that their idea of the upgrade to the MLS was garbage. So I'm like, okay. Like you say, cautiously optimistic.
Yeah, you know, AI powered photo tagging, photo captioning, and public remark generation. Well, we all know how that's going to play out. You know, yeah, we'll see. We'll see what happens. Do they have any
on automatically? I would leave that on.
Okay, I guess they do have an
That gives
update
you
here.
the ability when we go into a listing to
Okay, so there you have it. They do have the new listing manager there. So, okay, so they've got that. So yeah, so take a look at this video, I guess. Okay. I mean, it just looks about the same. Oh my gosh, look at that dashboard. You see, that's the thing with this dashboard. You need like a massive screen to use this dashboard. And most of us work out of laptops. That's the problem that I have with these modern day web developers, is that they're developing on their massive, 24 to 36 to 48-inch screen without realizing or without even caring that 90% of our work is mobile. 90% is like, we are not looking, we might have that second monitor at home that's really nice and big, but 90% of the time, what are we using? We're using our laptop. And then when you take this interface and you shrink it to a laptop, it just becomes unmanageable. Like, you just can't, it becomes super ineffective, right? And then the other thing is like, do we need like this many screens and this many dashboards and icons and all that? Like, do we need all of this? Like, no, like we don't need all of this stuff. We just need the absolute basics. So it looks like they do have a video here kind of showing you the deal. It just, yeah, we'll see what happens. Seems like it's a lot of screens. Seems like it's a lot of screens. Yeah. We'll see what happens. It's probably going to be just super frustrating. That's probably what it is. I mean, here's a CMA tool. Yeah, we'll see what happens. Oh, well, yeah, we'll see what happens. I just hope they don't mess with the export feature. Like, if they mess with the export feature, I will lose my mind. I'll lose my mind because we use the export feature all the time. Okay, let's take a look at a few more things right here. We've got, for listings, still focus on pricing rather than offering rate buy downs. Buyers will just ask for it regardless. Yeah, you're absolutely right, Seth. I would 100% just focus on pricing so that you can just be very competitive when they're going to ask for it anyway. So just focus on pricing, 100%. 100%. Any other? Okay, so I just saw your question right there, Melanie. Thank you so much for asking. I appreciate it. And looks like that is it, you all. Well, and Seth got amped up with the amazing music that Abor had on their video. Oh, wait, wrong one. I just clicked on something different.
Gives you the ability.
Yeah, there's the other music. I think we're talking about this music. Now some other music. So there you go. Well, you all, thank y'all so much for joining. Super appreciate it. Stay tuned with all the updates on the market. I want to remind you all that we do have our Tuesday morning mentorship meeting tomorrow, Tuesday morning here at Team Price. We do have our Wednesday contract review, broker Q&A and training. No meeting on Friday, no meeting on Friday, no meeting on Friday. I will be in the dreadful city of Denver, Colorado. Weather Denver CO. And when I say dreadful, it's not because I love parts of Colorado. I'll say that much. Although Denver, like, it can be super dangerous right now. It's kind of crazy. And you can see that it's going to go down. I'm going to be there Friday, Saturday, and Sunday. No meeting on Friday. No meeting on Friday. I'm going to be there Friday, Saturday, and Sunday, and take a look at that bad boy. It's going to be -4 degrees, you all. In AccuWeather, weather Denver, Colorado, AccuWeather has it even colder than that. It's going to be insane. Take a look at the weather in AccuWeather. I mean, just, okay, 12, -1. Crazy. So I'm going to be there Friday, Saturday, come back Sunday. I actually leave Thursday. I leave this Thursday at about 2, 3 a.m. because I drive there. I'm driving there. I don't want to mess with delayed flights. The kiddo has to go back to school. But I am driving there Thursday morning. I'll probably publish the weekly stats I might do it on Wednesday. If not, then super early Thursday. You'll kind of wake up to an email, wake up with everything done. So I want to leave by about 2, 3 a.m. so that I can get there around 3 to 4 p.m. so that she can rest and be ready for some pretty high-level hockey games. That's what we've got going on. So I'm not going to be here Thursday. You can reach out to me. As a matter of fact, call me because I'll be bored off my mind driving. So if you just want to, call and chat, feel free to do that. I'll gladly answer your phone call. And that's the drill. No meeting on Friday. No team meeting on Friday. And then, of course, on Monday, we do have a national holiday on Monday. So no Monday morning touch point the following Monday. It is a national holiday. And be sure to celebrate the amazing life and legacy of Dr. Martin Luther King. That's going to be Monday. So no meeting on Monday in remembrance of Dr. Martin Luther King. Have an absolutely amazing rest of your day. If you have any questions, comments, concerns, criticisms, or complaints, please reach out. Here to help. Otherwise, I will chat with you later.